Prime Minister Mark Carney is busy reassuring Alberta and oil executives that a pipeline or two to non-American markets will be coming shortly. China and India are the two biggest Asian markets for Alberta's ultra-heavy sour crude, but they're a long ways away and shipping costs are very high. So, what about markets closer to home? The U.S. Gulf Coast is about to experience a shortage of heavy crude oil, the kind that comes from the Alberta oil sands. President Donald Trump recently pulled Venezuela's import license, which will exclude 200,000 barrels per day from the Gulf Coast market. Mexico is another Gulf Coast supplier with problems. Its heavy crude production is in terminal decline. Plus, the country is expanding its refining capacity to eventually process all roughly 500,000 barrels per day at home. This chart from S&P Global shows how much heavy crude production from both countries has declined over the past 20 years. Combined, the two countries produced over 4 million barrels per day. Now it's just over 1 million and dropping. Mexico's fields are old and declining. State oil company Pemex hasn't had the capital or the technology for enhanced oil recovery. The current national government isn't friendly to foreign investors or oil companies. In Mexico, state oil company Pemex has faced chronic underinvestment and limited access to technology for enhanced oil recovery. A combination of mismanagement of the government-owned oil company and U.S. sanctions has crippled the Venezuela oil industry. Infrastructure has collapsed and become useless. Like Mexico, Venezuela lacks the capital, technology, and expertise to reverse the decline of its industry, which is why Gulf Coast refiners will soon be looking to Canada to replace the lost supply of crude. This is a quote from Selena Wang, a senior analyst at Commodities Insights in a May 29th S&P Global article. Quote, Canadian producers can fill the void, but not overnight. End quote. There's another twist to this story. Venezuela's 200,000 barrels per day of heavy crude will now flow to China, the very market Canada is hoping to tap with a new pipeline to the British Columbia coast. And it will probably outcompete Canadian exports. Mexico pays just $5 to $6 per barrel shipping to China, while Canadian producers pay $15 to $18. Is expanding their presence in the Gulf Coast market an opportunity for Alberta oil sands producers? Chart number 2 from S&P Global shows that Mexico and Venezuela together exceed Canadian supply to the Gulf Coast. If Canada replaced those countries, its share of the Gulf Coast market would increase from 34.5% to 73%. Should those producers renew their focus on the U.S., where they are hands down the lowest cost barrel of heavy crude oil? Admittedly, this is a tough question. Canada already supplies about 2/3 of U.S. crude oil imports, 4 million barrels per day in a 6 million barrels per day market. About 3.3 million barrels of that is ultra-heavy sour crude from the Alberta oil sands. If Alberta replaced the Mexican and Venezuelan imports, that would grow its heavy crude exports to the United States to 4 million barrels per day, about 80% of American heavy crude refining capacity. Now, if it did that, how would all that new crude supply get to market? Chart number 3 shows the shipping capacity that can be added to existing pipelines. 650,000 barrels per day, almost enough to replace the lost or soon-to-be lost Mexico and Venezuela crude. And there's another option, partial upgrading, a promising technology that was supported by the Alberta government until 2019. Oil sands bitumen is so thick, like peanut butter, that it must be diluted so that it flows in a pipeline. Diluent, which has no or little value, takes up 20% to 30% of the pipe. Partially upgrading dilbit, as it's called, to a medium or heavy grade that can flow without diluent would free up space in existing pipelines. Now, the Alberta-based oil industry has for a long time complained about the discount it suffers because of having one customer, the United States. And that gives refineries and traders leverage to negotiate lower prices. That might be true when Alberta supplies 60% or 65% of the market, but is it true at 80% or more? And is it true when the global heavy crude oil market is tightening because of decline in countries like Mexico and Venezuela? Maybe the best strategy for Canada is to maximize its existing assets, like pipelines to the US, and increase its market share to the point where it can be a price maker, not the price taker it has always been. At the very least, Canada should be asking these questions as it considers fast-tracking pipelines to the west, north, and east coasts.